I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.
Hello and welcome to another installment of Liberty Nation's Swamponomics videocast. I'm Andrew Moran, Liberty Nation's economics editor. This week, learning the lessons from the Silicon Valley Bank and Signature Bank failures. It has been about a month since the second and third largest bank failures in U.S. history. It was a chaotic time in the financial markets and the U.S. government as everyone tried to avoid a contagion event. For now, the Federal Reserve, the Treasury Department, and the Federal Deposit Insurance Corporation put a band-aid on the banking turmoil, preventing a full-blown collapse of the financial system, but the key term is a band-aid. Once again, U.S. policymakers insisted that these poorly managed institutions and wealthy uninsured depositors needed to be bailed out. This, of course, creates an environment of moral hazard. A party is incentivized to take on risk because that party will not bear responsibility for that risk. Now that financial institutions know Washington will intervene no matter what prevents companies from taking on extra risk? And if depositors possess an understanding that politicians and regulators will protect their deposits even if they exceed the $250,000 limit, why not find banks that offer the same outrageous deposit rates as SVB did? In recent weeks, there have been mixed messages. Treasury Secretary Janet Yellen noted that only banks posing systemic risks to the financial system would be shielded. Fed Chair Jerome Powell suggested the American people should have confidence that their deposits will be fine, hinting that the central bank can employ tools to avoid a meltdown. But then President Joe Biden told reporters that the Federal Deposit Insurance Fund could be tapped for deposits above $250,000 if other U.S. banks failed. Yeesh. Ostensibly, the worst-kept secret in Washington today is that the government will permanently bail out banks. In other words, if J.P. Morgan Chase, Bank of America, and Wells Fargo were to fail tomorrow, the nation's capital would come to the rescue. But would these saviors also save a community bank in the forests of Arkansas? This is the $250,000 question. Considering how the Biden administration picks winners and losers, there is plenty of uncertainty. Meanwhile, the House and Senate have been holding hearings to understand what happened. Republicans assert that regulators fell asleep at the wheel because they had already possessed the tools to rein in a bank like SVB. This makes sense. Fed Vice Chair for Supervision Michael Barr confirmed that supervisors found signs of distress dating back to 2021. Democrats argue the GOP's deregulatory push under the previous administration created this mess. But is this true? Under Trump, the threshold and frequency of receiving a stress test were altered. However, SVB would have already passed with flying colors since the stress test would have homed in on how the bank would have fared in an economy of a falling GDP, rising unemployment, and tighter credit conditions. Right now, the main issues challenging the U.S. economy and banking system are higher inflation and rising interest rates. The Fed contends that this was a textbook case of poor management. How could the management not have braced for an economy of higher interest rates? Plus, the bank did not have a risk management offer, but get this, it did have a diversity, equity, and inclusion officer. Amazing priorities. Ultimately, the real culprit was the Federal Reserve System. Like then Fed Chair Arthur Burns in the 1960s and 1970s, the central bank kept monetary policy too loose for too long, making the U.S. economy accustomed and hooked to a period of artificially low interest rates. The Fed then launched quantitative easing on steroids during the coronavirus pandemic, resulting in rampant inflation and trillions in liquidity flooding the system, or trillions of cheap money flooding the system. Once monetary conditions tightened, the easy money exited the financial landscape and nobody acclimated. And then there's the issue of regulations, which is the purview of the federal government. The banking system is one of the most regulated sectors in the world, meaning that the financial institutions will take on risks to offset the burden and costs that come with these regulations, which then of course leads to moral hazards, and then you come full circle. In the end, the United States will always find the money to bail out the elite and the well-connected. Remember, SVB and Signature were not mom-and-pop depositors, but tech bros and executives. As Senator Sherrod Brown of Ohio said during a recent Senate Banking Committee hearing, there are no libertarians in Silicon Valley, but the reality is that there is no libertarian philosophy in the United States today. That's it for me this week. Please read my full Swamponomics column on the pages of LibertyNation.com, where I discuss the broader de-dollarization push, first quarter stock market rally, and crude oil prices. Thank you.
Entertaining, informative, and just plain fun. Watch Liberty Nation's The Conservative 5, produced by conservatives for conservatives. C5's The Left Free Zone, hosted by Liberty Nation's Lisa K. Donner, joined by a raucous, irreverent panel of authors, deconstructing leftist narratives, debating the hot topics, and remembering to laugh. Join the official conservative safe space.
You only did that to piss Jeff off.
Liberty Nation's The Conservative 5.
I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.